Hello, my name is Vasudevan. Today we're going to talk about the international cost of capital. So what do we have to do here when you talk about the international cost of capital? We want to talk about the different components of the cost of capital. We want to talk about the weighted average cost of capital, how we adjust for risk, and what happens when we have segmented markets. Okay, so that's what we want to do here today. So I think in previous corporate finance, you have studied the cost of capital, and you have also used the cost of capital. So when you talk about capital budgeting, what we say is that the value of a project is the present value of the future cash flows. And to find out the future cash flows, the present value of the future cash flows, usually we use the weighted average cost of capital. Okay. Now, basically, the value of the project depends upon reliably estimating the risk and the cost of capital. So the cost of capital is very important in risk estimation, and failure to properly assess risk leads to valuation errors. So this is what typically we talk about with reference to the cost of capital. And weighted average cost of capital is used to value corporations, projects, etc. So if you talk about finding the value of a company, basically what we say is that the value of a company or the total price of a company is the present value of the future cash flows. So once we know the value of the company, we can also use that to find out the value of a stock as well as the price per share. So all that we're going to do is the value of the stock is the present value of the future cash flows minus the value or the price of the bonds. And the price of each share is going to be the total value of the stock divided by the number of shares outstanding. Okay. So what are typically the sources of long-term capital? They tend to be coming from bonds, coming from preferred stock, and coming from common stock. So these are the three components. And out of the three components, when you talk about common stock, we can have the cost of retained earnings and the cost of new common stock. So when you talk about the cost of retained earnings, so if you look at a company like Apple, they have around $50 billion in retained earnings. Now, what is the cost of that? The cost of retained earnings is the same as the cost of equity. What about the cost of new common stock? The cost of new common stock is going to be higher. Why is it higher? The reason why it's higher is because the company has to pay money to investment bankers and so on. So typically when a company sells new stock, around 7% goes as commission to investment bankers. Again, they have to pay accountants and so on. All said and done, when you talk about an IPO, the cost of new common stock is going to be around 15% of the total money they raise goes as fees to the investment bankers, accountants, lawyers, and so on. So what is the weighted average cost of capital? The weighted average cost of capital is given by the weight of each security multiplied by the after-tax cost of that security. So the first security we have is bonds outstanding. WD stands for the fraction of bonds. RD is the cost of debt, and typically that is given by the yield to maturity of the bonds, and T stands for the tax rate. So what we are doing is the weight of bonds multiplied by the after-tax cost of debt. WPS stands for the weight of preferred stock multiplied by the cost of preferred stock. And the last one is the weight of common stock multiplied by the cost of common stock. So that is the weighted average cost of capital. So basically here, what is the definition of the weighted average cost of capital? So let's say we plug in the numbers and we find that for Walmart, the weighted average cost of capital is 12%. What it tells you is that that is the cost of the marginal dollar. So that is the cost of the last dollar. Or essentially what it means is that for every dollar that Walmart raises for investment, it is costing Walmart approximately 12 cents. So how do you find out the weight of each security? So basically here, WD, WPS, and WS, that tells you the fractions of each security that the firm has. So weights are determined by firm's capital structure, and usually based on market values of securities rather than book value. So all said and done, we want to use the market value of common stock, the market value of preferred stock, but in practice what typically people try to do is that they tend to use the book value of the bonds outstanding. And the reason why they use the book value of bonds outstanding is because one thing is that it's very difficult to find the market value of bonds because bonds are not frequently traded and so on. The second is that usually there's not much of a difference between the market price of the bonds and the book value. So let's look at this world equity risk premiums. So what we are talking about here is that usually when you talk about finding the cost of equity, one choice is to use the CAPM. And if you remember from the previous class you took, that is corporate finance, one of the components is the equity risk premium. So what we have is here is that we have the equity risk premiums all over the world over a 3-year period. So in Australia, the risk premium during this time was less than 2% in US dollars. In local currency, it was around 3.5%. In the US, the market equity risk premium is 6%. In the UK, it's 6%. In Germany, it's 7%. In Belgium, it's slightly more than 8%. And in Japan, it's closer to 12% in US dollars. So why do we see such big differences in the equity risk premium? I'd say one of the reasons being that it all depends upon the risk aversion of the people in those countries. So basically here what we are saying is that in Australia people are more daring. Typically that's what we hear in the news. They have a lot of wild animals, people like to hunt and so on. So in those types of scenarios people are perhaps more willing to take risk. So that's perhaps one of the reasons why the risk premiums are very low in Australia. On the other hand, in Japan, they had tough financial times for a long period. They had a recession and so on. Given that, people are more risk averse. And basically, because they are very risk averse, to entice them to invest in the market, you had to pay a very high risk premium. Okay? So in the case of the capital asset pricing model, the capital asset pricing model uses the stock's exposure to market risk to find RS. Okay, that's what they do here. And how do they do that? Let's look at this example. A common stock has a beta of 1.2 with respect to the domestic stock index. The risk-free rate is 4.75 and the domestic market risk premium is 6%. Okay, that's what we have. So given that, what should be the cost of equity? So the cost of equity is given by the risk-free rate plus the beta times the market risk premium. So RRF stands for the risk-free rate, BI stands for the beta of the stock, and RPM stands for the market risk premium. So basically here, for this company, the cost of equity is slightly less than 12% or 11.95%. Now, how do we find out the global CAPM? So in the previous class you talked about the domestic CAPM. So what is the global CPM? In the case of the global CAPM, we regress the stock returns against a world index. So we, rather than use the S&P 500 or the Nasdaq, we are talking about the world index. And usually, what is the world index people use? That tends to be the Morgan Stanley World Index. And the one place where you can find that is mscibara.com. Okay, so if you go there, you can find out the prices of the world stock index. And if you do that, global CAPM approach, so when you talk about a US firm going abroad and something like that, one thing they can do is they don't want to talk just about the US stock market because it is a multinational firm that could have operations all over the world. And if this company operates in integrated international markets, what do we need to use? We want to use the same risk-free rate, 4.75, but we want to use the world risk premium. And the world risk premium is 5%, and the firm's beta with respect to the global index returns is 1.1. So what is changing here is that the beta of the firm is changing. Why is the beta changing? Because now we are talking about a different market that is used to find out the beta, and that is the global index. So with the global index, the beta goes up and the risk premium goes down. So what we find out is that for this company, because it's a multinational operating in integrated international markets, the the cost of equity is going to be 10.25%. Okay. So what we have here is that we have the world risk premium and we have the beta of the firm. So the first number that tells you is that if the firm has a beta of 0.9 and the world risk premium is 3%, the cost of equity is 7.45. If the world risk premium is 5%, the cost of equity is 9.25, and with a beta of 0.9 and 7% market world risk premium, the cost of equity is going to be 11.05. Now what happens if the beta goes to 1.1 like we saw, and if the market world risk premium is 7%, the cost of equity is 12.45. So what we are trying to show here is that our estimates of the cost of equity are very sensitive to two things, and those are the beta of the firm and the world risk premium or the market risk premium. So whenever you talk about estimating the beta, you have to be careful about how you estimate the beta, what is the appropriate market that you want to use, or what should be the index that you should be using. And basically here, what we are saying is that all said and done, you typically, at least for this class, you should be using the Capm to estimate the beta. Now, I use these notes talk about the bond plus risk premium. That's really not very appropriate for us. The second choice would be to use the discounted cash flow. So if it's a corporate finance course, people also talk about the dividend growth formula. And if we know the dividends of the firm, we can use that to estimate the cost of equity. Okay. Now, what about the global Capm? The global Capm works only if the firm is operating in countries that have access to integrated international markets. If the firm operates or is appraising a project in a developing nation, the firm is operating in a partially segmented market. So what we are saying is that whenever we talk about a US firm going to Vietnam or going to China or going to another country, let's say Pakistan, usually we are talking about a project in a developing nation, and in that case what we are saying is that the market may not be fully open to international investors. So there we are talking about a partially segmented market, and in that case we might have to use a slightly different approach to estimate the cost of capital. So in the case of the global Capm, we want to use the world risk premium and a firm's project risk exposure to find the cost of capital, and here we are assuming that international markets are integrated. On the other hand, a segmented Capm adds an additional parameter to account for the risk due to the segmentation. Okay, so basically here what we are saying is that if we are talking about a segmented market, there is some additional risk and we have to incorporate that in our analysis. And the segmented component can represent either a specific country or geographic region's risk, and this method works especially well in Latin America. Okay, now that's one way to do that. Another way is to use the country spread approach. And what is the country spread approach? Low returns correlations between emerging and developing markets cause global CA estimate to be too low, and consulting firms develop the country spread approach to handle this problem. Adds a spread between a specific US dollar denominated sovereign bond yield and US Treasury yields to the standard domestic Capm. Okay, so what is the Goldman Sachs method? Basically what they are doing here is that they are using a country spread. And what is the country spread? The country spread is the difference between the US risk-free rate and the risk-free rate in the foreign country. So let's say that we are going to Mexico. The country spread would be the yield to maturity of bonds issued by the Mexican government. So those are the risk-free method, or that represents the country risk for Mexico minus the yield to maturity of bonds issued by the US government. So basically here the difference between these two yield to maturities is a measure of the additional risk of going to Mexico. So we are talking about country risk. And what do we see here? The return of a stock or the return of an investment in Mexico is given by the risk-free rate in the US plus the country spread plus the beta of Mexico times the risk-free premium in the US. So what we have here is that, okay, so these are risk-free rate plus the country risk spread plus a US equity risk premium times the market risk premium US adjusted by the Mexican market beta represented by the beta of Mexico. So I think to understand this, you want to read the handout I will be posting on my courses. So that is an article written by two people who used to work at Goldman Sachs, and they basically came up with this model we can use to estimate the returns when you invest in a segmented market. Okay. So in a segmented market, the return in Mexico is given by the risk-free rate in the US plus a country risk spread plus a US equity risk premium adjusted by the relative standard deviations of the two markets. So basically here, what we are doing is that we are talking about a completely segmented market. Earlier, we talked about a partially segmented market, and here we are talking about a completely segmented market. Okay. So let's look at this case. The country credit spread for Venezuela is 6.5%, and the ratio of market standard deviation in Venezuela to market standard deviation in the US is 0.38 divided by 0.19 equals 2. So basically here what we are saying is that the standard deviation, overall standard deviation of the Venezuelan stock market is 0.38, and the standard deviation of the US stock market is 0.19. And the difference between the yield to maturity of bonds issued by the Venezuelan government and the yield to maturity of bonds issued by the US government is 6.5%. Okay. And once we have that, we can find out the cost of equity for a US firm, let's say going to Venezuela. So that is the US risk-free rate plus the market risk premium, which is 6%, times 0.6 is the beta of the firm in the US multiplied by the relative standard deviations. Okay, so that is pretty much like finding the domestic CAPM, very similar, plus we are adding the country spread. So that is 6.5%. So overall the cost of equity is going to be 18.45%. Okay. Now we talked about finding the cost of equity. What about the cost of debt? So what is the cost of debt? Usually in the case of the US, the cost of debt is the yield to maturity of the bonds. Now what happens when we go abroad? So when you go abroad, what we want to do here is that if the company issues bonds in Venezuela, the cost of debt or the yield to maturity is 6.67%. So there, if it's a local company in Venezuela, they could be issuing the bonds at 6.67. Now what happens if it is a US company? The main difference is that in the case of a US company, when they issue bonds in Venezuela, they face foreign exchange risk. So there, if the Venezuelan currency appreciates against the US dollar, the US firm might have to pay more over time. On the other hand, if the Venezuelan dollar currency depreciates against the US dollar, it means that the cost of debt will go down. So what the first thing we want to do is we want to look at the expected appreciation or the depreciation of the Venezuelan currency. So that is the forward rate divided by the spot rate minus 1. So one thing you want to be careful about here is that, so what we have here is that F by S minus 1. Okay, so and here what we have to do here is that the forward rate is 1625. So that is going to be 1 over 1625 divided by 1 over 1598 minus 1. Okay, so that is what we want to be careful about when we do this exercise. Okay, so that is what you see here, and the cost of debt is going to be, okay, that's what we see here, F by S minus 1. Okay, so F is 1 over 1625 and S is going to be 1 over 1598 minus 1. Okay, So that gives you negative 0.01615. Okay, so essentially what it tells you is that over the year we are expecting the Venezuelan currency to depreciate against the US dollar. And once we have that, we can find out the cost of debt. So the cost of debt is going to be RD times 1 minus T times 1 plus delta FXC plus delta FXC. So basically here RD is 6.67, T is 0.4, the tax rate, and 1 plus delta FXC is going to be 0.983385, and the reason being that FXC is delta FXC is negative 0.01615, okay, and minus plus delta FXC. So here the last part is 0.016615, and that gives you a cost of debt of 2.27%. Okay, so sorry about the handwriting you see here. Somewhere it came from the previous page. Okay, F by S minus 1. I just trying to show that. So the cost of debt is 2.27%. So what we see here is that for a firm in Venezuela that issued those bonds, the cost of debt was 6.67%, and the after-tax cost of debt would be 6.67 times 6.67 times 0.4. Okay. So that could be around 4.02%. Now, because this company is a US company, it also gets some benefit because of the change in the exchange rate. So if you take out the 1.7%, the answer you get is 2.3%. So roughly that is the cost of debt. And the reason why we see that is because the before tax cost of debt is 6.67, the after tax is going to be around 4.02 minus the change in the value of the currency. That gives you 2.27%. Okay. And once we know the cost of equity and once we know the cost of debt, the weighted average cost of capital here is going to be 16.83%. Okay, so the hard part I think is deciding what is the right model to use and then using that to find out the cost of equity. And then we want to find out the expected appreciation or depreciation of the currency. And finally, we have to use the after-tax cost of debt. And once we have that, we can find out the weighted average cost of capital. So these are the two things you can expect as far as the exam or assignments are concerned. How do you find out the cost of equity? How do you find out the cost of debt? And finally, how to find out the weighted average cost of capital. Now, the last example I want to show here is basically we want to look at what happens when a market is suddenly open to foreign investors. Okay, so here we are talking about Nestle, and Nestle used to issue two different classes of common stock, bearer shares and registered shares. So foreigners were only allowed to buy bearer shares. Swiss citizens could buy registered shares, and because the foreigners could not buy the registered shares, there was only a limited amount of bearer shares. There was a lot of demand. So what we find here is that although the stock paid essentially the same type of dividends and so on, the bearer stock was more expensive. And the reason why it is more expensive, because there was more demand for that type of shares. Now what happened on November 18, 1988 was that Nestle lifted the restrictions imposed on foreigners, allowing them to hold registered shares as well as bearer shares. So what we are talking about here is that what is the effect of demand and supply on a stock price? And that's exactly what happened when Nestle lifted the restrictions imposed on foreigners. It basically meant that the market was opened up suddenly to foreign investors. And what we see here is that prior to that announcement, the price of bearer shares was much higher than the price of domestic shares. But at the announcement, the price of bearer shares went down and the price of registered shares went up suddenly. So basically here, the price spread between the two types narrowed dramatically, and basically tells you that there was a major transfer of wealth from foreign shareholders to Swiss shareholders. The price of bearer shares declined by 25% and the price of registered shares rose by 35%. And what is the benefit as far as the company is concerned? Their cost of capital therefore declined, because suddenly they found that overall the price of their shares went up, and which meant that the cost of equity went down and the cost of capital also went down. Okay. So what is another example of this? One of the other examples I can think about, at least from a US point of view, is that usually you have a set of stocks that are listed in the S&P 500. And usually what you find is that for those shares, there is a lot of demand from professional investors. So, mutual funds, hedge funds, and so on, they tend to buy those shares simply because they are listed in the S&P 500. Now, sometimes the S&P 500 makes changes. They might remove some of the shares and add some new companies. So what we find there is that whenever a company is removed, chances are a lot of these professional investors sell those shares, which means that the price of those shares will go down. At the same time, the new company that is added, there is going to be an increase in the demand, and usually because of this, you will find that the price of those shares tend to go up. So basically here, what we are finding is that we are talking about the law of supply and demand, and mainly because of the law of supply and demand, changing, we are finding that the price will also change.